A rising wedge is a bearish pattern, but may also appear as a continuation pattern. It takes at least two higher highs, ideally three, to form upper resistance line, and at least two higher lows are required to form lower support line. The resistance and support lines must converge as the pattern matures. Now the selling point is the breakout of this lower support line. The target is then calculated by measuring the distance from the highest peak on the pattern to the lowest trough, projected downward from the breakout point. Now this pattern in an uptrend is considered a reversal pattern, and in a downtrend is considered a continuation pattern. Now this rising wedge usually forms over a 3 to 6 month period on daily charts and can mark an intermediate or long-term trend reversal. Now why is wedge a strong pattern? Many traders get confused here. They wonder why this pattern suggests strong bearishness as the market is continuing to advance only and is making higher highs. Now the reason behind this pattern being bearish is because the advances from the reaction lows are becoming shorter and shorter, which makes the rallies look unconvincing. Okay, so let's examine a chart now. This index has been in a strong uptrend. A rising wedge requires at least two higher highs to form upper resistance line and two higher lows to form lower support line. Notice here how the lines converge as this pattern develops. Volume also diminishes as the pattern continues to evolve. The selling point is going to be this breakout of support line, and profit objective is calculated measuring the net distance traveled from the highest peak over here to the lowest trough over here and projecting the same downward from this breakpoint, and the target is seen to achieve here. In this chart, we are again going to probe into rising wedge, but as a continuation pattern. Now, wedges are typically reversal patterns, but they also tend to evolve as a continuation pattern. Now, this stock chart has been in a downtrend and then gives a brief rally. Whether this rally is having a bullish tone or is merely corrective in nature can be known interpreting volume. Observe how volume declines during this phase and is therefore supportive enough to suggest that the rally in progress is corrective in nature. Also, we have converging resistance and support lines in place forming a wedge. Recall that at least 2 points are required to establish resistance and support lines. Price breaks this support line over here, suggesting us to go short, and profit objective is calculated measuring the net distance traveled from the highest peak over here to the trough over here and projecting the same downwards from this breakpoint, and the objective is met here. Now this chart is of a currency pair Euro USD. See the wedge pattern formation over here. This is upper resistance line. This one here is lower support line, and the lines are converging. Please remember that lines must converge, otherwise you will end up trading something which is not a wedge and be ready to face the consequence. So okay, this is the breakout point of the support, suggesting us to go short, and target is going to be calculated measuring the net distance traveled from the highest peak over here to the lowest trough over here, and then projecting the same downwards from this breakpoint. Now, I want to tell you something vital. Patterns do work, but that doesn't mean they are infallible. They do fail. Each pattern is having a probability of success attached. Now, this little trick which I am going to tell you in just a moment will certainly eat a bit of our profits, but will boost success of this trading pattern. Instead of selling when the support line is broken, look to sell below this swing point over here. Now at times you will notice that price briefly breaks this support line, consolidates for a while and continues to rally. But this approach, which is waiting for this swing to be taken out, will make sure that you are not getting trapped too often. Now having said that, if you are conversant with other technical studies, one such being candlestick, then you would have probably known whether to sell or not right here, anticipating the formation to be a true wedge. You may sell aggressively here rather than waiting for the price to break either support line or the swing point. I believe it's visually clear how you possibly can multiply your profits by analyzing a situation using other studies and then forming an opinion. If you know a certain candle pattern developing here and go short anticipating wedge to unfold, you are multiplying your profits as you have bettered risk-reward ratio significantly.